Capital Group. Welcome back. Today I wanted to talk to you guys about 30-year loans, cash out refinance rate of term. Um, a 30-year mortgage, it's basically a note that you buy a property and we hold that note for 30 years. It has principal, taxes, insurance, and interest involved in that payment. Okay. DSCR loans are used to buy investment properties. So for example, let's say you buy a property that's rented. We use the debt service cover ratio to qualify that property. Basically, want to know what is the debt to income ratio on that property. How much money is a property making versus how much your mortgage is going to be. As long as your DTI is over 1.2, we can probably do that. Meaning that for every dollar that you need to pay the loan, you got 20 cents left over. Okay, so big differences. 30 years fixed rate. Let's go over this one. At the time of this loan, this video, this is the interest rate for this loan. Okay, 7.99. We can do up to 80% LTV, loan to value. Minimum purchase is always going to be 100,000. It doesn't matter what type of loan we're doing. Minimum credit score. Anything from a single family all the way to multifamily on 30-year loans. Okay, and then this is a long-term loan, and it's for acquisition. There's no seasoning requirements for this one. This loan is fully amortized, and the property doesn't have to be rented. Meaning that you can go the route of trying to do an STR, and we can use the prediction that VRBO gave you an example, and we can use to qualify that. Or based on what other properties are being rented for in the area. And that's when you do an appraisal and you order a 1004 and a 1007. One is going to be the appraisal for the property, the other one is going to be the appraisal, meaning that's going to compare to all the properties that are in the same area that are being rented for. We can use that. When we move to a cash out refinance, pretty much the terms are the same, but interest, LTV, purchase price, FICO. Then we move from single family all the way to fourplex. We're not doing a multifamily cash out on that one. Okay, and then it's going to be either long or short-term rentals. We can do both. The thing is that this property has to be, you have to own this property for the past 6 months. That's the only seasoning requirement on this one. Okay, depending on the property, how good the property is, we can do 4. To be safe, let's say 6 months. Okay, again, this is a fully amortized loan. You're paying taxes, insurance, interest, and the principal, and then the property doesn't have to be rented. Let's do what we call a rate and term refinance. You just refinance and you're not paying for, getting money out of it. Then we're capped at 75 LTV. Purchase price is the same, 100K. Same for credit. Same for the type of properties. And usually this is done, you're doing a fix and flip, and let's say, remember fix and flips, we spoke before, this is a 12-month bridge loan, interest only with no prepayment penalty. Let's say you did a fix and flip, and the loan is for 12 months, but you finish this property in 3, 4, 5 months. Then you can come back, we do reassess, we do another appraisal. We see how much appreciation you force doing your rehab, and then based on that, we'll tell you how much we can provide. Again, we're capped at 75 LTV. So basically, you used to pay the existing loan. There's no seasoning requirements on this one because you're not doing a refinance. You're just paying off your fix and flip. Again, this is a loan that's fully amortized, and the property doesn't have to be rented. If you guys have any questions, feel free to reach out to us. Again, phone number at the bottom. You got a contact card, email, or if you want to talk to us directly, you can make an appointment here to our calendar. Hopefully, we can work with you guys and help you fund as many deals as possible. Thank you.